Hello everyone, today I'll be revealing my £43,000 plus portfolio held in my Trading 212 stocks and shares ISA. I hold a highly concentrated portfolio of stocks, just 9 holdings with a focus on monopolistic companies and predictable free cash flow growth. I'll be going through my overall return and free funds, recently hitting a new milestone, then discuss each position, its returns individually, and some interesting facts about the companies themselves and why I invest in them, before discussing how I'm growing this portfolio into the future and when I plan on allocating funds and my money into this portfolio. So if you get something out of this video, then please feel free to leave a like and maybe consider subscribing to the channel so you don't miss out on everything. So to kick it off, let's talk about my overall return for this portfolio. As we can see here, we have an account value that sits at £44,373. This is all held in our stocks and shares ISA and therefore is tax free, except for withholding tax on specific dividends from companies I hold in other countries. That usually is taxed about a 15% rate on those dividends. Then we get the free funds, which sits at about £1,061. This is part contributions, part dividends. I pull it all together. And then we've got the current tax year. I've used about £18,000 or so, a bit more than that, and the remaining is about £1,227. Obviously, we can't use more than 20k per year, so I'll have to wait till April 2025 before reinvesting new funds back into this portfolio. But to give a bit of perspective, this free funds gets about a 5.1% savings rate that is paid daily. Not 5.1% daily, that would be insane, but 5.1% annually that is paid out daily, and that sort of keeps topping up into these free funds, which is really good while I wait to make my investments. Then we have my overall return in capital gains, which is sitting just over 10% right now, or £4,130. Now this just shows the capital gains of unrealised gains. It doesn't show positions sold or dividends reinvested as a overall return. Now if we looked at that sort of performance, we're looking closer to about 13% or just over that, or around £5,000. Now let's look at individual holdings to see where those sort of returns are coming from. So first off, we have my largest position, which is Amazon. We have 74 shares at a value over £10,600 now, going towards £10,700. We're up by about £370 or so, around about 3.6%. Now, when we look at this a bit closer, we can see that I was buying around the $176 mark, and we have a little bit of FX impact that is affecting this overall return. Now, what I like about Amazon is that it's no longer an e-commerce company, in my opinion, or just an e-commerce company. It includes the #1 position in cloud services that is just growing really quickly with AWS, with the re-acceleration in growth. And then we've got the second highest position in online streaming services, behind Netflix with their Amazon Prime service, which provides good subscription revenue. And then that's followed by the third highest grossing advertisement business behind Meta and Google. So all of these parts of this businesses, or little mini businesses of Amazon, are better margined than the e-commerce side of the business and growing at quicker rates. So to me, I see that Amazon's business is becoming more highly margined. This increases their profitability and overall will produce better returns in terms of free cash flow and operating cash flow into the future, which I'm really excited about for this company. And it has a weighting of about 24 to 25% of the overall portfolio. So it's a big part of the overall performance for this one. My second largest position, we have Visa at 34 shares at an overall value of £7,200 or so. We're up about £120 on the position, or around 1.7%. The reality is the FX impact has affected this one a little bit on those gains, and the average share price that we were buying at was $263 per share, which isn't that far away from the share price of $277 now. And our overall weighting is sitting at about 16 to 17% for Visa at the moment. I'm not openly buying into this one at the moment, and we'll see what happens into the future. VICI is just a company I love the scalability of their business model with, and I love the effective duopoly they have with MasterCard in the credit and debit card space. They may offer a small dividend yield that sits below that 1%, but I think the effective dividend growth you are getting, which is raised upwards of the double-digit percentile ranges, I think it was raised about 16%. Last time they raised dividends, is just amazing and something I'm looking forward to seeing grow into the future, along with this position in terms of capital gains. Next on the list is my Salesforce position, which we have about 30 shares of at over £6,600 now. Now, it's done quite well quite recently. It's up about £700 now, close to about 12%. And we can see in the past month, it's up about 15% on just this position. So it's doing fairly well right now. I would say that our average share price of $248 was quite a good one. I quite liked buying into this one down then. I did think it was undervalued, but I'm not massively happy with the portfolio allocation for this one. So at the moment, the allocation sits around 15%, and I'd prefer it to sit closer to about 10%. But that's just for my comfort levels. And at the moment, I can't see any reason to sell out of this position, as I don't think it's overvalued right now. Salesforce is just an excellent cloud platform that works on customer relations. So they optimize a business based off a customer's needs. And they're the number one in this space. Their competitive advantage being that they're number one in the world, and the barriers to switch to other providers is quite difficult to entrench. They've got a good moat in that regard. I don't openly use the service myself. I have seen how it's used and I'm very happy with this company's suitability for the future, but I would prefer a slightly lower allocation in the portfolio. So next on the list we have Brookfield Corporation, which is my only Canadian held company. We have 23 shares at a value over £5,000 now. We're up about 15% on this position by about £672. And this is a position I wanted to add to for a while. Its holding is sitting at about 11% in the overall portfolio. And that's actually increased from around 10% because in the past month they're up about 12%, which is just really impressive on their own. What I would say is that Brookfield is just an amazing company all round. They're effectively a holding company for the likes of all types of business. Now, that is mainly due to their asset management business, or BAM, which is really profitable and has over $1 trillion in assets right now, which they profit off of and gather fees from. We've then got their insurance business, which is just growing rapidly and very unprecedentedly. And then we've got the likes of infrastructure, where they invest in like the backbone of the Canadian economy. So I would say that this company in particular is just really good in capital allocation. And I really like their approach to how they believe their shares are undervalued and will buy back opportunistically, along with their management team. Bruce Flatt and stuff like that are really good people to be investing your money as an investor. So I really like this business. I wanted to add more to it, but because they've gone up so much after Investor Day presentation that went really well, they showed their amazing performance of their company versus other companies' share prices, the likes of Amazon and Walmart and stuff like that, where they outperformed the market and big companies like Berkshire Hathaway over the past 20, 25 and 30 years. And sorry, you can hear my dog in the background. But yeah, so I really like this business and I like where they are sitting at. I like them below $50. That's where I wanted to buy more at, but I just don't see them going back down below that level. So we'll see if I get to allocate some more money to this one into the future. Next, we have an excellent growth-based company, if you ask me, which is Mercado Libre, which is my only international stock, I would say. So I've got 2.3 shares sitting over a value of £3,600, and we're up about £750 on the position, or around 25%. And this is another one that's done quite well. It's down about it's up about 2% this month, but over the past 3 months it's up about 18%. So it's one I really like. I liked it when I was buying it around $1,600. I believed it was undervalued then. Now I think it's sitting closer to about fair value. But I really like this position, mainly because it's just probably the fastest growing revenue stream in the whole portfolio that I've got. At the 9 holdings, they're growing their revenue at premium revenue growth, which is upwards of 20%. I think they're closer to about 40% more recently, year over year. So we'll see how earnings go coming up, but I would say MELI is just an amazing one for growth overall, and also profitability. Their free cash flow growth is just amazing as well. Now, to call them just an e-commerce platform would be a bit unfair. Obviously, they operate in Latin America and they have amazing fintech business that is growing as well. So I really like both those aspects of the business. The fintech business is higher margined, but it carries some risks as well in terms of credit and stuff like that. So I really like Mercado Libre as a brand and their ability to beat out other competitors in Latin America specifically, like the likes of Brazil and Argentina. They've done really well in that, and they've actually beat out Amazon in these sorts of countries. And their fintech business is undercutting a lot of the big banks in Brazil in terms of how they operate, because the local people are more willing to trust Mercado Libre with borrowing and money than they are maybe than the big banks, which is interesting really in terms of how these economies are. One risk I see with MELI is that it's an international space. Latin America is underdeveloped economies now, and they have high levels of corruption in certain areas like Argentina, with inflation and economy affecting this company's margins specifically. However, I'd say that MELI have done very well in navigating this, specifically in Argentina, where they were seeing slowdowns in growth that has massively flipped on its head, and that's why we've seen this share price increase so well, because people won't expect them to do well in Argentina. But they've navigated it really well and come out the other side quite well. How they go into the future and what areas they break into in this space, we'll see. But at the moment, I like its allocation sitting just below 10%. I wouldn't want more than 10% for MELI, because my concern would be its overexposure into international markets and economies that I can't really cover very well into the future. So we'll see with that one. But I really like having exposure to this company, and I'm be really impressed to see how this one grows in the future. So I've got no intention on selling it. Next on the list is my only real estate trust, which is VICI Properties. Now we have 140 shares in VICI, sitting over £3,400, and we have about £200 up in the position, or around 6.5%. We can see my average share price sits at closer to about $29.53, with the current share price sitting at $32.47. And its allocation sits around 8% right now for VICI. Personally, I think VICI is a real high quality REIT. They have two things that are really going well for them. Their tenancy agreements are triple net, which basically effectively safeguards them against interest rates and inflation. Effectively, VICI price that into their agreements with their tenants, which are all high quality. So when I see that with VICI, I see why they've done so well during this high interest rate period. And now the interest rates are coming down, I can see this one going up considerably in share price, because the company overall will be doing better. REITs operate high interest environments quite badly, and low interest rates environments quite well, because they like to borrow money and then use that to buy real estate, which they then obviously rent out and make money on. One thing I would have to say also for VICI is that their tenancy agreements and the tenants they rent out to, get rent from, are just really high quality. They don't have that many tenants, and the ones they do pay them millions. So when I see that VICI has never not collected rent for its services and for the buildings it provides. That basically means that all the way through COVID, they were still collecting rent, which just means that VICI is just really high quality and probably the gold standard, I would say, for a REIT or company like it. Now, where I get onto REITs is my problem. I don't really like how REITs dilute shareholders' positions, and my position specifically. So we'll have to see how this one develops in the future. It is my highest dividend payer. It pays about 50% of my overall dividend annual income for the year. So I would have to be very convinced to buy into another company over VICI because it's such a high value real estate trust and a high provider of dividend yield. But I don't believe in buying companies for their dividend yield, and I don't like the dilution of shares that real estate trusts operate under. Next is S&P Global, which I have 7 shares of at a value over £2,700 now, and we're up about £420 on the position, or around 17 to 18% in the green. We can see that my average share price sits at $419 per share, with the current share price sitting at $517 per share. And the overall weighting is a bit low at 6.4%. Now personally, I'd like that to be higher with S&P Global. I think they're an amazing company that is specifically running an oligopoly with the likes of Fitch and Moody's, and has been for the past 20 to 30 years. So this is a company that is paid to rate individual companies' debt. Companies have to do this unavoidably, and they don't really have a choice in the matter. They've got to do it to get a sort of fair return on debt. So they have to pay S&P Global and other companies just like them, like Moody's or Fitch. So I really like that, and S&P Global use that to grow other aspects of their business, like their analytics business. So they're really a good and high quality company that I'd prefer higher exposure to, but the share price has gone up considerably over the past year, and over the past 3 months about 8% or so, sitting flat for the past month. So I like S&P Global. I'd prefer a higher allocation, but it's just not really possible right now. So we'll see what happens in the future. Now we have my smallest position, which is Texas Roadhouse. We have 18 shares at a value over £2,400 now. We're about £750 in the green, or 44% in the green. And we have an average share price that sits closer to about $118 per share, whilst the current share price is sitting at $176 per share. This one's performed very well for me. In the past year, it's up about 84%. And we was actually buying in this sort of low around the $90 mark in our other account before selling that position and making a sizable gain then. So I really believe in this company. It's effectively a sit-down restaurant that is always opening new restaurants, and its brand is quite likeable. They always are getting sold out in their restaurants. So I really like this business. It's done very well, and they just keep opening restaurants and filling them up. So Texas Roadhouse is just one that people didn't think would do well when I was buying it, mainly because there was problems with buying meat and meat prices overall. The company abolished that really with higher margins than everyone expected, and that's why the share price has just soared since then. They just continue to perform and execute very well. And then they've got their dividend growth, which is just impressive. Their dividend yield sits currently around about 1.35%. When I was buying them, they were closer to about 2%. And my yield on cost is sitting closer to that. What I like about them is their dividend growth, and has been growing very impressively over the past years, COVID being the only exception. So when I look at this one, I'm happy to continue to collect the dividend yield from this one, but I'm not adding to it currently at the moment. And its allocation is currently sitting closer to around about 5.69%, which is just over 5%, which isn't really that bad, but quite a small position now in the overall weighting of the portfolio. And lastly, I have my smallest position, which is Alphabet or Google. Now, this is quite a new position. I have around 10 shares over a value of £1,200 now. And we're up about £100 on the position, or around 9%. We can see that my average share price is sitting at $49 per share, and the current share price is sitting closer to about $163 per share. Personally, I really like Google as a company. They're really good, but you can see my current weighting is sitting closer to about 3%. So they're very small in their allocation, and I'd like them to be a little bit bigger. Mainly because they have the #1 position in terms of advertisement revenue. They own YouTube, which is really successful for them and collects a massive stream of revenue in terms of ads as well. So I really like Google. Their Google Cloud is about the 3rd highest, I believe, and fast growing as well. So whilst I look at Google as an amazing leader in tech, I also see it as a company that has diversified its business streams away from advertisement, which is quite nice to see because they were heavily reliant on that. The DOJ investigating them and talking about a breakup is just seen as a good opportunity to me. I don't believe they're likely to break up Google. I think that would be a lot harder to do than they initially think. And even if they did, it would be worth more than even if they didn't break it up. So I'm not really too worried about buying this one, hence why I bought it with this sort of low when sentiment was really bad. I'm hoping to add to this position if it does come down towards my cost basis again. I don't know why I'm not buying around these levels. I'm just hoping for a better deal, as I always tend to, if I'm honest. So this is my overall portfolio and the positions that I hold. Now, obviously, these positions are highly concentrated. I've investigated these companies individually. I have good sentiment around them, and I'm more than willing, if these positions were to go on massive dips, to add to any of these positions. So that's what I like. I like the high conviction in my holdings, and that's why I hope to invest in companies not just freely when they are undervalued, but when I believe in the companies themselves. And if they continue to drop, then I'm not going to feel bad around my investment and lose sleep over it. I don't really have a lot of money to invest, only around £1,000 or so, and £1,200 to play with after that. So I'm currently waiting for earnings season to decide whether things may go on suddenly unjustifiable dips. People often have unusual viewpoints on and interpretations of earnings reports. Sometimes they think they went really badly when I interpret them as being quite good. And then sometimes the market changes its mind very quickly. So I'm hoping for a bit of an unjustifiable dip in any of these positions. Hopefully, the ones that I would most like to add to are Google, Brookfield Corporation, and probably S&P Global. The drop for these two companies would have to be quite a bit, and for Alphabet, probably not that much for me to reinvest. But I'm more than happy to add to any of these positions, bar maybe VICI if it went on significant dips, because I just really believe in the companies themselves. The only reason I exempt VICI is because, like I talk about, is their dilution of shareholders, and that's something I've become less comfortable with as an investor over time. So this is still something I'm trying to grow, but tell me what you think about these positions, whether you like them or don't like them, and maybe why, and I'll continue to talk with you down below. But thank you for watching, I do appreciate it, as always, and thank you, and I'll catch you in the next one.